SoFi is on the way to dominating finance like Nvidia does with chips. In this video, I'm showing you how 3 first principles that allowed Nvidia to dominate now set SoFi up in the same way. I'm Emlyn, and I'm fortunate enough to have retired at 40. Multiple 5 to 30x stock picks changed my life. The ideas I'm sharing here helped me buy Tesla in June 2019 at 1580. Tesla is now up nearly 30 times. It also helped me buy Palantir at 926 in 2022. I sold Palantir last year at 123.95 for a 13.4 times return. Now, I'm not a financial advisor, and this isn't financial advice, it's guidance. 1. So unique, they have no competition. Nvidia used to be known for making GPUs for games, but instead of asking, how do we make better GPUs for games, they asked, how would we redo computation if we were reinventing it for the age of AI? More than a decade ago, it allowed Nvidia to start building a world that never crossed Intel's mind. In finance, most consumers rightfully complain about expensive hidden fees, predatory behavior. Think of Wells Fargo that literally duplicated customer accounts just to increase their income. An awful customer experience from dealing with a fragmented bank. Typically, a client has to deal with multiple people across multiple divisions of a bank to get all their banking needs met. They deal with one person for savings, another for loans, another for insurance, and I can go on. But SoFi aims to solve this by providing a one-stop shop for all banking needs that are lower cost, easier to use, more transparent, and have a better customer experience. You sign up to their app once and access to anything else takes minutes. And they're doing so well that one of the main reasons for growth is spreading through word of mouth. In my previous life, I worked as a trader at a bank. I was there 18 years, and after the financial crisis in 2008 and all the new regulations came in, compliance costs exploded. This hurt profitability of the banking industry quite badly. Many banks are now a shadow of their former selves. Some banks like Credit Suisse, Merrill Lynch, and Dresdner even disappeared. Some will say that they were bought by other financial institutions, but when the institution is under massive duress and it's a fire sale, can you really say that? One thing the banks could never overcome was the ever-increasing cost of regulations and compliance. Clear evidence of this is how the global bank model died. Banks like Citibank, JP Morgan, Barclays, Royal Bank of Scotland, and HSBC were all large global banks, and they were increasing their size across the world until 2008. Since then, they've all retreated. To JP Morgan's credit, they fought the pressure all the way. However, they're now still mainly an American bank with significant investment banking and asset management services in Europe and parts of Asia. They no longer have the means to replicate what they have in the US to large parts of Asia, Africa, or South America. And it's not their fault. The global bank model is just too costly across multiple jurisdictions and regulators. Compliance and regulatory costs are permanently more expensive. Better technology is not going to bring it down to what it was like before 2008. We need something new to be built from the ground up. More on this later. Another way how legacy financial institutions have been unable to avoid increasing costs is how the bank has to be divided into clear segments. These segments must have clear firewalls that prevents losses from spilling over into the rest of the bank where it could affect other clients. These firewalls also prevents crises from spilling over to other banks or into other countries. Further, there are strict rules about client details having to be held within each bank division and jurisdiction. Many banks have thought, why don't we look at everything a customer does with the bank and then create a more personal and lower cost service to serve them? But the client's insurance products, everyday banking needs, or long-term financial planning will often be done by different divisions with different systems, compliance, legal team, and regulatory requirements. So they can't just come together and share the information they have. You might have experienced this with your bank. When you want another product, you have to fill in a whole bunch of forms with information they should already have. Or maybe you thought an interest rate you got for a loan was unfairly high considering you're a high earner and have investment products with them. These are all symptoms of how hard it is for legacy banks to bring everything together. SoFi solves this by being digitally native and starting with an all-inclusive platform that puts clients first. Further, like Nvidia, SoFi has the long-term mindset in building this platform. On the other hand, hamstrung by all the issues I've mentioned, legacy financial institutions instead focus on short-term returns. They are not making the long-term investments paired with the long-term thinking because it is hard. I might even say that it's impossible for legacy banks to do this because it requires a CEO that will be around for at least 10 years. Shareholders also have to accept that they're going to build a new bank from scratch that slowly eats the old one. This is not going to happen. And so I would argue that SoFi is unique to the point of having no competitors. If they do, it's probably other fintech companies or maybe crypto. 2. The inevitable disruption of finance in the fourth industrial revolution. Going back to Nvidia, they didn't try to make better GPUs for games. Instead, they asked, how would we redo computation if we were reinventing it for the age of AI? When we apply this to finance, the question becomes, how would we reinvent banking for the fourth industrial revolution? This is a thought experiment, but to me the answer is clear. The ideal bank is blockchain-based. This increases trust and moves money instantly. We're already seeing this. SoFi just launched their stablecoin and Lightning Network remittances in 2025. This also reduces the need to constantly verify your details, so it improves customer experience while lowering costs. From the bank's perspective, it reduces the cost of complying with all the regulations that have hampered legacy banks. 2. Ultra low cost. This includes international payments. If you've ever traveled the world, you know you can pay away anything from 3 to 10% of your money in credit card and exchange rate fees. 3. One single app. Everything. Banking, loans, insurance, crypto, and retirement funds under one login. Now someone is going to win. There will be a bank 10 years from now that meets all these needs, is massively profitable, and reaches enormous amounts of new customers because its products are cheap and easily accessible. When you accept that a bank will meet these needs, you can look at who is most likely to be that bank. To me, the answer is obvious. SoFi is the most likely institution to be that bank 10 years from now. This same thinking of what will the world look like 10 years from now and who is most likely to be the winner was how I came across the enormous opportunity Tesla and Palantir presented. In Tesla's case, the world was obviously going to be on electric vehicles and battery storage. This is because they're more efficient, cheaper over the long term, and because of climate change, the world has no choice. In 2019, Tesla was the company most likely to win. That's why I bought them. With Palantir in 2022, it was clear AI was playing an ever bigger role in everything we did. Palantir provided a highly secure AI platform that customers could bring in-house. Now medical service providers and banks could harness AI without letting confidential client details leave their premises. Palantir had no competition, and so they were the only ones in the race at the time. But this thinking of what does a product or service look like in the fourth industrial revolution is how you're going to come across enormous 20x opportunities when you identify who is most likely to win. 3. SoFi, the long-term growth story. When you consider where we are now to where we're likely to be in 10 years, you see the potential for enormous growth over a very long period of time. You see that SoFi can grow by at least an order of magnitude. At the same time, they reach many more customers, they're transparent at much lower cost, and have high levels of trust with customers and society. Now SoFi is already profitable, generates cash, and is able to weather a downturn or crisis. It handled the tech downturn of 2022 very well. That was when I first bought. It also handled the mini bank crisis well. That's when Silicon Valley Bank went under. It's already growing quickly and with high margins, but I'm not going to go into these points in detail now. I think I'm going to structure these points as part of a mini course or longer video because I think they carry a lot of similarities with opportunities like Nvidia, Tesla, Palantir, and Bitcoin. But if you can learn to replicate this, it will serve you well as the fourth industrial revolution progresses. There will be many opportunities like this. Objection: why SoFi and not Robinhood? Robinhood shares have been performing very well and it makes sense many think it's better. However, I see many red flags. 1. Most of Robinhood's revenues come from trading transaction fees. This means when a client trades, Robinhood collects a fee. This is a huge problem because transaction fees from trading does very well when the market goes up, but it collapses in a market crash simply because many people stop trading, so their business revenue is volatile and vulnerable to a market downturn. SoFi's business is built on a diverse platform that provides everything from everyday banking, loans, insurance, to long-term financial planning and investment products. They also have a bank charter, making the client's business a lot more sticky. 2. Robinhood sells their client data. One way is called payment for order flow. This is when a client puts an order into their system and Robinhood will sell that data to another provider. So while they may say you're not paying a fee on a trade, they sell that data to another provider, allows them to execute ahead of you, giving you a worse price in the market. They will fine $65 million for this in 2020. And this practice is actually banned in the UK. 3. Robinhood's management has questionable integrity. If you're not yet convinced that Robinhood's management has questionable integrity, they also paid 2 other huge fines for bad behavior. In 2021, they were fined $70 million for widespread and significant harm to customers. And last year, they were fined $45 million for anti-money laundering failures, amongst other things. As a former trader, I know these things are easy to get right. You want to stay away from financial institutions with questionable integrity. They can disappear very quickly. Just look at FTX. That's it for today. Let me know in the comments. If you don't think SoFi is going to be the winner 10 years from now, who is it most likely to be? Remember to hit the like and subscribe button for more content like this in future. In this uncertain world we live in, may you find the financial freedom to live the life you want to live. Good luck.